What does it mean? We used to think the economy was relatively healthy, but now it's like cutting open a body and finding it's been critically ill all along. And here's the irony. Trump just fired the head of the Bureau of Labor Statistics, accusing him of manipulating jobs data. But then this revision comes out and actually backs up Trump's claim. The US job market had indeed been prettied up. But here's the problem. Even if you fire the director, even if you modernize the statistical methods, you can't change the underlying weakness of the job market. The data is just the surface. The real economic condition is the root. You have to understand, employment is the most important confidence indicator for the US economy. The Fed has been insisting that the job market is still solid, so they don't need to rush rate cuts. But now, with 910,000 jobs vanishing into thin air, the Fed's biggest argument has been pulled out from under them. From now on, if the Fed tries to use healthy employment as an excuse to delay rate cuts, it just won't hold up. Worse, this kind of data revision shakes market trust at its core. Think about it. If 1 month can be off by 76,000, how much inflation is in those pretty numbers from before? So much of the past stock market rally was based on fake data. Will investors dare to keep investing after this? When businesses make plans, can they still rely on government data? This is how market confidence gets destroyed. Bit by bit, another detail deserves our special attention. This revision of 910,000 jobs covers data up until the end of March. That means it doesn't even include the impact of Trump's reciprocal tariffs yet. In other words, the weakness in the job market was already there before the full effect of tariffs hit. Now, if you add the tariff shock on top of that, do you think future job numbers are going to look good? On top of that, tighter immigration policies are already making it hard for companies to find workers. Then throw in AI replacing more and more positions, putting white-collar jobs at greater risk. Under this triple whammy, recovering the job market will be harder than ever before. Guys, we all know employment is the prerequisite for consumption, and consumption is the pillar of the economy. If employment collapses, consumption will shrink. If consumption shrinks, what can the US economy rely on? That's why this jobs revision isn't just a data issue, it's a confidence collapse. So now we've covered all three big events, JP Morgan's three heavy punches, Goldman's stagnation prediction, and the labor. Statistics Bureau slashing 910,000 jobs. Looking at any one of them alone might not feel like a big deal. But when you put them together, a much scarier big picture emerges. You'll come to one conclusion: the Fed cutting interest rates not only won't save the economy, it might even amplify the risks. Why? Let's break it down point by point. First reason, demand side collapse. Rate cuts reduce retirement income, weakening spending among older groups. A weak job market makes younger folks worried about unemployment, so they hold back on spending too. When demand cools down, the economy takes a further hit. In the past, rate cuts stimulated spending because people had confidence in the future. They were willing to borrow and spend. But now it's different. Rate cuts aren't bringing confidence, they're bringing anxiety.